Now we get to go to my favorite topic, which is China. So there's a lot of data that came out. There wasn't a lot of data, but these are important pieces when we look at what's happening going forward. So the manufacturing PMI was expected to be down 48.9, came in at 49.3. And again, as we were saying, it's going to just kind of flatline. And that's where it's going to stay in contraction. But between that 48 and 49.5, and you're going to see it kind of live there just because exports are terrible and they're not getting much better. Internally, things are still very slow. So again, you're seeing that catch up. And then, while manufacturing flatlines, again, back to our point on the slowing components on the service consumer, non-manufacturing. Non-manufacturing was expected at 53, came in at 51.5, putting the composite slightly in expansion at 51.1. That is not a country that is growing at 5%. And that's what we've been trying to hone in. It's not that China is going to see this massive collapse in GDP, but they're going to struggle to maintain even a semblance of growth of 2%, let alone their target of 5%. Now we turn to the Caxton. The Caxton was expected to be at 50.1, came in at 49.2. Not quite sure why they were in expansion. We've been saying in general that they were a bit overstated, and now they're coming back and they're kind of lining up with what we're seeing. Services was expected at 52.4. They actually saw a bit of an acceleration of 54.1. But net, if you look at kind of the balancing act, they weight manufacturing a bit more. So still, when you look at the composite, it's still right around that 51.9. And we do think that there's going to be a bit of that slowdown. On a stimulus side, and this is just looking at liquidity. So the PBOC does different injects different yuan levels, and it's a 7-day reverse repo, and you're actually starting to see them pull some money out of the system. Now, it doesn't mean that they're going to continue to do that, but it's important to look at what is the PBOC doing, and we don't see a hard pivot. And this is, I think, a key piece. The government has refrained from giving cash subsidies to residents, focusing on providing benefits and tax breaks to companies instead. That has been a very steady thing they've done over the years. The new measures were announced, and by new measures, they're essentially just keeping the tax breaks and renewing them because some of them were set to expire the end of this year. So again, there's no new measures. It's just very consistent with where they currently are. The last time that the indicators had pointed to contraction for more than 3 consecutive months was between May and October of 2019. Remember, where we were getting bearish on the global economy was in that back end of 19 before the pandemic. The non-manufacturing PMI, which incorporates sub-indices for services, sector activity, and construction, dropped to 51.5. U.S.-based data providers said Chinese consumers cut back on spending on everything but travel and restaurants last month. So restaurants were a bit better. Travel was stronger because remember we did have some holidays and restaurants, but everything else fell. So I go back and forth with someone on Twitter, all in good fun, but they showed what happened with Pizza Hut and KFC. It's like, well, yeah, restaurants were strong, but general consumption is still down and weakening. Almost every major sector experienced a weakening in both revenue and profit margins compared with June, led by a steep slide in retail. According to the China Beige Book, sales in travel and food and drink increased, defying the trend due to continued revenge spending in those sectors as general retail continued to slow. But investment is falling in almost a third of mainland China. And remember, a lot of the governments front-loaded or were asked to front-load a lot of their special purpose bonds and LGFVs or local government financing vehicles. New export businesses contracted at the fastest pace since September. Stocks of finished goods were accumulated for the first time since October. Employment and manufacturing fell for the 5th straight month, and the average input cost continued to fall, but again, kind of slowing. So none of that is showing in growth, especially when you look at inventory stocking. It shows a deceleration again on the consumer side as well as we've seen exports. Almost a third of the Chinese provinces recorded shrinking investment in the first half of the year, the most widespread decline for the same period since 2020, as financially strained local governments and companies cut back on spending. People have said that, and this is going back to some comments in the YouTube chat, the comments, was that, oh, it's top down, CCP is going to take care of it. It's a communist nation. It's like, well, no, they need local governments and companies. And without them, you're going to see that continuous slowdown because a lot of these local provinces are laden with so much debt. And which is why we saw Guangxi and Tianjin had the biggest contraction in fixed asset investment in the period. The decline in investment is weighing on the economy's recovery, which has lost momentum since China's reopening. Weaker economic growth, in turn, will make it difficult for some provinces to service their debt, resulting in further pullback in investment. Local governments have pulled back on investments following a slump in land revenue, which is a key source, which we talked about. In the first half of 23, income from land sales dropped 21%, reducing revenue for the various government budgets by 17% and making it difficult for the Ministry of Finance to meet its income forecast for the year. Guangxi and Tianjin were among the 10 provinces cited by Fitch Ratings where local governments related debt was most at risk of refinancing pressure. Tianjin's debt was almost 3 times its income last year, while Guangxi's was 144%. Yunnan and Guangzhou, which were also highlighted on the Fitch list, have debt ratios of 172% and 164% respectively. But yet some people say, but the federal government doesn't have, or the CCP doesn't have a debt problem. It's like it all rolls up. So yes, it does, because they all guarantee it, because it is a communist nation. And then now when we look at where we are on the Chinese economic activity, you can see it's all losing steam. Some of it is contracting, but you can see the trend on everything is down. Some of it is flatlining, as we were saying, but there's that drawdown, and all of that is when you look at construction, again, that service piece, those are going to come down. Construction had that nice bump. Again, front-loaded special purpose bonds, LGFVs, which were infrastructure-based, aka construction. That is now waned. Even though they're trying to drum that up, they can't get that meaningful move with more services pulling things down. Beijing doesn't want China's poorest citizens to slide back into poverty, because remember, they declared and they eradicated absolute poverty. Well, this is going to make it difficult. Ministry of Agriculture and Rural Affairs issued a notice that targets boosting the incomes of people who have been lifted out of poverty. In November 2020, Xi declared victory in his decade-long drive to eradicate absolute poverty. But with the economy buffeted by COVID in recent years, there are increasing concerns that China's poorest will slide back. Again, they changed the degree of poverty. Beijing has rolled out a series of fiscal, social, and market-related policy measures to support low-income individuals. MARA, which is the Ministry of Agriculture and Rural Affairs, increased monitoring of low-income individuals and those facing significant income declines, efforts directing companies to enhance job creation and ensure job security, targeted vocational skills. The notice demands increased efforts to ensure the number of people in work who are previously below the poverty line stay above 30 million. But extreme weather, ag price, as we talked about in segment 1, and slowing economy is going to make that difficult. And when you focus that much on just propping up that bottom piece, the rest slide down. And that's what we've always talked about. When you focus on the bottom, you bring down or as they say, propping up the top 20%, the bottom 20% pulls down the top 40. And that's, again, that consumer, because the consumption side of the equation, the disposable income still resides at the top, not the bottom. So again, that's why we see the consumer, another reason why we see the consumer slowing. Now, when we just look at the pace in general, you can see kind of the flatlining on Caxton, but look at Hong Kong PMI. And now Macau did have some improvement, so you have to kind of balance where things are, but you're getting a bit of a bellwether of where things are going. The State Council has promised to support the economy. As we talked about with the readout from Monday's State Council executive meeting, it is necessary to strengthen counter-cyclical adjustments and introduce new policy measures. Again, all of the same rhetoric. And I think China Beige Book had a good retweet looking at the title of the headlines from August of 22, and they were you could have just recycled them. And it's not because Bloomberg is lazy, but it's just because the rhetoric hasn't changed, but yet there hasn't been actual dollar amounts put to this. The State Council then listed a bunch of policies that read from the same playbook as July's Politburo meeting readout, promoting private investment. Again, private. For anyone who thinks this is all going to come from the CCP, has not been paying attention to what has helped drive some of this growth. It's been private, and that cracking down on it has been a problem. Now they're also cracking down on illicit fees imposed on businesses, bolstering investor confidence, fostering growth in strategic and emerging industries, optimizing real estate policies, stabilizing employment. Again, we've heard it all before. The State Council also called for an extension of pandemic-era business tax and fee reductions. Again, that's not new. That's just extensions of what's already there, which these policies signal a continuation of Beijing's existing approach to economic support, one that does not rely on short-term stimulus, but rather focusing on improving the business environment. But again, this comes back to the supply side versus the demand side. The call for strengthening counter-cyclical adjustments indicates that there's some appetite, but we haven't seen any of it come through as China consumption recovery underwhelms. And one of the things that we've said with retail sales is it wasn't going to just collapse. It was just going to go more sideways and underwhelm against these expectations, which is why China is seeking to boost that consumption to spur the recovery. But although the government has stopped short of providing direct fiscal support to consumers and companies to increase spending. Because remember, it's not supposed to be about the person, but the collective whole. So how do you give money to some? And they've tried to, and again, it's that balancing act. They've tried to say that the common prosperity is not a reallocation of money from the wealthy to the poor. But again, until which it would be a communist backdrop is, taking from the rich to give to the poor and balancing out that level is going to be an interesting way to kind of balance this. Now, like the measures announced on Friday, which are focused on boosting manufacturing in the consumer goods, but not the purchasing of them. But as we showed earlier, inventories are going up, making it a bit difficult. The latest steps are targeted toward improving the supply of goods in the economy rather than the demand. There's still no demand. Where is the demand? Everything that I've read, which is why I've been talking so much about why their stimulus will fall flat, it's more of the same. The government has refrained from giving cash subsidies to residents, focusing its support instead on providing benefits and tax breaks. Policies so far have tried to stimulate consumer spending, but the fiscal policy has not stepped up. China's fiscal deficit is even shrinking despite the mounting downward pressure on the economy, which we disagree with because, remember, there's a lot of off-balance sheet stuff that they're trying to bring back on balance sheet, which is why we do think that it's getting worse. There aren't much new policies in the documents there, and there's no real money provided to help families. So again, they're seeing some of their pressure continue to rise given some of these underlying pieces. Shrinking sales of new properties by China's 100 biggest developers is down again. It's down 33.1% versus 2022. And it's been a continuous down move. And as those sales shrink, remember, a lot of consumers lent to these guys. They lent money to them. They were guaranteed returns. They put life savings in there, and it's now gone. Last month, new property sales by China's top 100 property developers totaled 350.4 billion yuan, or $49 billion US dollars, down 33.1% and down 33.5% month on month. Total sales in the first 7 months of the year dropped 4.7% year on year, which again, a lot of this means that these people that were relying on this, the money is now gone. The ability to purchase is now gone. Beijing is trying to help private companies. On Tuesday, the macro planner led 7 other ministries in issuing a task list to implement the July 19 guidelines from the Central Committee and state councils on boosting the private sector. Again, they're trying to boost the private sector. I can't stress enough where people think that it can all be SOEs and the CCP. It can't. The SOEs are a small percentage of the underlying percentage of companies available, and they're picking up more and more of the weight because the private sector isn't doing it, and it's doing it, and the SOEs are doing it under debt. They're increasing their leverage, rolling debt, or trying to do something, which is why we continue to see this struggle. And it's the most concerted effort to boost the private sector, but it comes in the wake of 10 years in which the party has made private business feel unwelcome. That means that officials will need to go the extra mile to convince them. But again, that's not something we see attainable in at least in the next 8 months. China continues fiscal pullback. When you look at the activity, nearly 60% of China's 100 largest real estate firms did not acquire any land in the 7 months ended July 31st. They collectively purchased 11.6 trillion worth of land, a dive of 20%. As you can see, things continue to slow. China is facing real structural difficulties, not a temporary downturn, in which case rhetorical support for entrepreneurs and consumers will not be enough. Something more ambitious may be needed: direct fiscal transfers to households, big bang improvements to China's social safety net, or convincing a return to an ambitious market-friendly reform agenda, which flies in the face of what Xi has done over the last decade. Not something we see changing, which is why, and again, everyone is looking at this and saying, well, you're going more and more communist. In order to address this, you have to go less communist, and that's going to be very difficult given what they've been selling to their people. China slipping into oversaving and deflation, which again we've been talking about with the GDP deflator getting a bit better. But again, it's getting better on an inflation standpoint because people aren't spending. Continued contraction, Chinese manufacturing is boosting Asian stocks. Hopes that Beijing will unveil concrete measures to support the stalled economy. Again, recent numbers are bad enough that Beijing will almost certainly unleash some sort of supply-side stimulus, which it has always resorted to. But again, they're gonna fall flat. Now, when we look at some of the movements, new home starts fall to the lowest since 2006, and China's government debt, as you stack it, yes, does the central government debt, the official number, low, but all of it again rolls up to the top. Several Chinese provinces have uncovered that local consumption vouchers issued in recent years were not only misused, they did little to increase spending. Again, that's what we've been talking about so much, is it all sounds great, but in actuality, it doesn't actually deliver what they are promising. The biggest problem with the consumption vouchers was not that they were inefficient, which they were, or misused, but they were issued in amounts too small to matter. Again, if they were bigger, they'd continue to be misused, and that's why we continue to see the pressure. Residential pre-sales, again, people are strapped for cash. They're not looking to go out into any pre-sales. And the raised bets that regulators are keen to follow through on promises made at last week's meeting have been disappointing. And that's why, again, we're not going to see the consumer about face. China manufacturing PMI, again, kind of flatlining where we said. When you look at non-manufacturing PMI continuing to slow, they extended their tax breaks. But now when you start looking at China took the debt crown from the U.S., again, looking at the aggregate, newly issued local government special bonds and monthly renminbi, as you can see, very front-loaded. So it's going to be difficult to push more of that through, given the fact that you've already pushed so much in. China's export prices move in tandem with import prices. So again, things have gotten a bit better, and some of that deflation has moved into the market, into the U.S. As well. Chinese consumers cut back on spending on everything but travel and restaurants, contributing to the sluggish revenue growth in the country's key economic sectors. Almost every major sector experienced a weakening in both revenue and profit. As we've been saying, China's manufacturing, which has showed signs of improvement in previous months, also faced mounting headwinds, which is why we see that kind of, not that it's going to be headwinds and push it lower, but it just won't move it into expansion. Then you look at, again, the PMIs, kind of everything coming together. Both manufacturing are now below 50, signaling the Chinese economy continues to deteriorate. Leading economic indicators of manufacturing and service activity in China were also weak in July, evidence that the world's second biggest economy is losing even more momentum, which we see here. New orders, 48.4, deceleration. Export orders, a big move down from kind of bouncing, waffling, now a steep drop, which again, we've been saying, we've been seeing, and that's something that will continue. China manufacturers stocked up on inventories over 2020, 2022, and we haven't seen it drop. Again, that sideline move, which is why we're not going to see that spending. China fixed asset investment by firm, all of it showing that continuous slowdown. No sign pickup in housing sales. Sales by top 100 developers, as you can see, slowing. Developer source of funds dropped to only half of pre-COVID levels. As you can see, going back to 2009, they're not raising money because they can't get money. and they're already sitting on so much debt, nobody wants to go bigger. BOJ policy tweaks. The Bank of Japan tweaked their which spurred higher yields. They're willing to create the cap for 10-year Japanese bonds at 1%. But again, they're in this fungible point, which we're going to show in a minute. And they've actually launched now two, not one, but two unplanned purchases because the move higher was so exasperating that they tried to get in front of it. And that's when you start looking at Japan. Real household disposable income continues to be negative, putting a cap where even though retail trade has moved up, we actually see that rolling back down because remember, this is June. July is getting much worse with Japanese industrial production, again, moving negative. When we look at Taiwan, manufacturing PMI gotten a bit worse. South Korea kind of balancing out and bouncing. And we see this for both, just bouncing, but in a contractionary standpoint. India, on the other hand, did see some love. India's manufacturing sector maintained strong growth in July, posting 57.7, right in line with last month, while the services saw a healthy bounce to 62.3, bringing the composite to 61.9. So things remain very robust in India, and India stays as one of the bright spots. We do see some slowdown, but again, some slowdown is relative. Business expectations survey in India got slightly worse, but again, it's just it's more showing that the pace will slow. But when you're starting in the 60s and high 50s, slowing brings you to 54, 55, not this massive collapse as the India private sector credit growth continues to kind of flatline, again, leading to a bit of that stabilization. But just to round it out and finish on the BOJ, the 10-year government bond had a huge spike. Japan's 10-year government bond yield dips and the yen's weakness as the BOJ makes its second unscheduled bond buying announcement. Because one of the things, they went from a hard ceiling to what they're calling nimbly conducting market operations between 0.5 and 1%, which gives them the option or the openness to do these unplanned purchases to kind of keep guys guessing. It doesn't matter. The bond market is going to plaster this at 1%, and it's going to force them to do this until they yield. And while they are forced to do this, because when you buy bonds, you're issuing yen, you're going to see the yen continue to press up. It's already broken 140. It's likely heading to 145, which is going to slow down, which is going to increase inflation. It's going to hurt real wages, and again, pressure retail spending. So again, we don't see a lot of growth, and we see the first crack in the developed world on a bond issuance coming in Japan as QE infinity, which was begun by Japan in 1998, finally meets its end. So that's what we have for you today. If you have any questions, please feel free to reach out. We covered a lot of stuff. I went a little bit faster to keep this a little bit shorter. But again, there's a lot of things to discuss and a lot of pressure that remains, especially as China slows. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.